If you have a business, you can do a Roth 401k with a Roth option and get around any income limitations. And you can set aside 3 times what you could do in an individual Roth account.
It's time for the My Retirement Clarity Podcast with Lee Perkins, financial planner and president of J.L. Perkins Wealth Management. Get ready for a good dose of inspiration, simplicity, implementation, and of course, clarity on how to successfully prepare for retirement and grow and preserve your wealth. Here's Ben George with Lee Perkins.
Welcome into the My Retirement Clarity Podcast. On today's show, I've got a very special guest with me, Steven Brewer. He is the owner of Steven C. Brewer CPA firm right here in Macon. His firm specializes in working with business owners, but he's really very knowledgeable, of course, with taxes for individuals as well. And that's why I wanted to have him on the show today. Steven, what's up, man? How you doing?
Good. Thanks for having me. I'm excited to talk about some good old taxes.
Absolutely. We love talking about taxes. So Appreciate you joining me here today. So I wanted to give the listeners to the show some additional perspective on taxes from somebody who really deals with this stuff on a daily basis. You know, I hate taxes. My clients hate taxes, but yet you've chosen to surround yourself with taxes on a daily basis. Do you just love taxes?
I don't know how it happened. I ended up in that class in college, and it just seemed right to get a job, and here I am.
And here you are, 20 years later. I got it. This is a quick story. When I started out in college, I went to Mercer, and they ask you as an 18-year-old, what do you want to be the rest of your life? And I was like, I want to be an accountant. So I took my first accounting class the second quarter in. And I got my textbook from somebody that I know that had the class the quarter before. 2 weeks later, I figured out they changed the edition of the book. I didn't know it because I didn't pay attention because I'm not detailed enough to be an accountant. So I did not do very well in accounting, and I immediately changed my major in that. So yeah, not good, not a good accounting student. So yeah, so it's definitely not for everybody, but I'm glad that you're here. Glad that this is what you do. So, all right. So before we jump into things here today, I wanted to remind our listeners, even though Steve and I, we love talking about taxes and tax strategies and all this stuff, but please don't take something that we say on the show here today and implement it on your own without talking first to your tax professional. So we're not giving you specific advice about your situation because, of course, we don't know you. We don't know anything about your situation. So there is our disclaimer. Steven, anything you want to add to that?
Yeah, I think a lot of times when I'm talking tax, especially in a setting like this where me and you are just talking because we've done it 100 times before, I have a particular situation in mind. And so sometimes things just kind of roll out, based on some environment I have in my head. But the answer in tax is always, it depends. There's
Correct.
Never any other answer.
Yeah, exactly. Yeah, I find myself giving that same answer a lot of times on the show when we get listeners send in questions to the show. And the answer, it almost is always, it depends. So anyway, Good deal. All right. So in the past, you did personal taxes, and now your specialty is sort of working with business owners. So I know you've seen a lot of things. So I guess my first question is really about the typical relationship between a tax preparer or CPA and the client. So, because what I see most of the time is people don't really seek a whole lot of value from their CPA because really all they do is they take a big box of stuff over to their CPA's office, sometime in March and say, hey, sort through all this stuff, this big box of stuff or bag of stuff and find something that I can deduct. Right. Do you see that very often? And if so, what's the problem with that?
Yeah, we don't see it a ton in what we do because we only take clients that let us do their work monthly. So we have less of that, and it's on purpose. That's very common at all kind of every firm. That happens all the time. The problem with that is you can't do tax planning very well in March. After calendar year end, you lose a ton of options. So especially if you have a business, you need to have those books in order so that in October, November, you can do a real tax plan and actually have time to do some things. Very few things can you do after calendar year end.
So I can't come to you on December 15th with all of my books here from my firm and say, hey, what can I do to maybe help my situation in the next 2 weeks?
I will say you were grandfathered in. We would let you do it for at least 1 year.
I got it. Well, we're going to do our best to not do that. But yeah, I mean, I think you're right. And I try to tell my clients the same thing. We're trying to, do more proactive tax strategies and try to, have my clients look at things way before the end of the year. And let's figure out, because like you said, the more time you have, the more adjustments you can make along the way. So, yeah.
Well, even in an individual setting, if you're going to do those capital gain loss harvesting, you got to know where you're going to be at bracket wise to see if that even makes sense, and can't do that after calendar year end.
Yep. Got it. Good deal. All right. So I also know a lot of times people sort of base the value that they place on their CPA, or maybe how good they think their CPA is, simply based on the deductions that they can find, because, everybody wants to pay the least amount of taxes. And, I think a lot of CPAs are happy to play that game, but in your opinion, what do you see happening to taxes in the future, and why might, the pay less today might not be the best strategy?
Right. Yeah. I mean, most anybody in our field would guess that taxes are going to go up. I mean, about the entitlement structure that's kind of gaining ground in the U.S. And in 2020, 60% of Americans didn't pay a dime of tax. That math is not going to hold.
Hold on. I want you to say that again. Did you say 60% of Americans don't pay taxes?
Yeah, that's right. In 2020, it was 60%. And that's a lot of that's COVID related, because there were some extra benefits given out with COVID. But even in prior years, I think it was low 50s.
Right.
And once you add any kind of an entitlement or credit program to tax, it's very seldom that ever goes down or goes away. And so I don't know that the 60% stat is going to go down just because we hopefully have COVID behind us.
Right. Yeah. And what I want the listeners to understand is when we hear the rich don't pay their fair share thing, you could almost argue that, I'm not going to say that the 60% that don't pay taxes are poor, but people that make money are paying taxes. And I don't know the stat off the top of my head, but, I think the top 1%, 1 or 2% of earners pay like 30% or something like that. They pay a large percentage of the overall.
Very large. I think it's the 1% pay like 20% or something like that. But then even if you go out a little further, it's like the 10% pay like the top, like 40%. Like and usually when politicians talk about the stats, they're usually picking and choosing their formula.
Correct.
Like they'll leave out tax credits or government subsidies for insurance or whatever it is. They'll leave out those things that as you go up in income, you lose tons of benefits. So
do you think you wouldn't think politicians would do that in order to get more votes, would you?
Right.
No, surely they wouldn't do that. So, all right. So, is there anything that you see kind of a trend or anything that people generally overlook when it comes to taxes? Are there opportunities maybe that some people aren't aware of, or maybe they're aware of and they simply just don't take advantage of?
Oh man, most of this is, there's no magic bullet in tax. A lot of people think I always think there's some special secret, but a good example is for the last few years, if you've been in Georgia Heart credit and Georgia Gold credit have been amazing for us for the last 4 years. Tons of people didn't even know about it. You could get a federal deduction and a dollar for dollar state credit. Typically, if you get a dollar for dollar credit, you can't get a deduction. So you could literally put 10 grand towards one of these things and make 13. You made money on a donation. It was an amazing thing. So stuff like that, that's going to be different going forward. They're changing the Georgia law, so we're going to probably lose some of that as a really great benefit. But typically, it comes down to planning. You want to plan your brackets out. And if you don't know your brackets, you don't really know what options you have. Should you fund an HSA? Should you start a retirement plan? Retirement plans have deadlines. If you have a business, especially, I think it's October 15th, maybe for simples, or October 1st, and 401ks are calendar year ends. But those are the kind of the low hanging fruit. Should you pay your kid from your business is a good one. Yeah. Lots of things like that.
Hey folks, Lee Perkins here. If you've listened to this podcast for any amount of time, you know how much I hate taxes, and I know you probably do too. Our politicians are completely out of control. Their spending is off the chart, and you've got to be prepared for increasing taxes in the future. So we've written a book called Diffuse: 7 Steps to Protecting Your 401k or IRA from the Ticking Tax Time Bomb. You're going to want to grab a copy of this book and learn how you can protect yourself. Then you'll have to decide if you want to take action right now, or if you'd rather wait until the IRS changes the rules of the game. Either way, the choice is yours. To get a free copy of the book, just text the word diffuse to 478-475-2050. That's DEFUSE to 478-475-2050. And we'll send you a free copy. Thanks again for listening. Now back to the show. All right, so we know what's going on politically, and we're going to try not to talk too much politics on the show. Sometimes I think it would be a fun topic to discuss, but we know people that the listening audience come from all sides or both sides, or if there's a third side, there's probably somebody on that side. But we could probably both agree that this administration is, how do I say this politely? They're fairly incompetent. They can't seem to do a whole lot right now. But what they're really, really good at, and this applies to both Democrats and Republicans, so I don't want our Democratic listeners to think that we're just bashing Democrats. So this applies to both Democrats and Republicans, is they are fantastic at spending money. So I know we can probably agree, everybody listening, we can all agree that taxes are going to increase even above what they're scheduled to increase when the Trump tax cuts sunset at the end of 2025. So what are some of the things that people can do to sort of plan for this increasing tax environment that we're in?
Yeah, as long as ever since the Trump cuts came available, even though a lot of people argue that they didn't get a cut, that's pretty much not true. There's very, very, very few specific situations where people did not get a tax break. And Roth conversions have been huge ever since then. Even our clients that are in high bracket, especially if they're on the younger side, and I mean 45 down, I think the Roth conversion almost makes good sense even in a really high bracket. So Roth conversions, whole life insurance make a lot of sense. Brokerage accounts in general. So anything after tax or rental property, I think makes good sense. Yeah. But yeah.
So people that listen to the show all the time, they hear me talk about Roth conversions over and over and over. And again, the whole concept here is, rather than having everything that you all your investable assets in a tax qualified account, a retirement account, growing tax deferred, the idea here is to take a portion of that. Let's play the tax bracket game, like you said before. Play that tax bracket game and convert up to the top of the bracket, or it's not a bad thing to even go into the next bracket when you sort of see the train that's coming down the track. So, we're obviously a big proponent of Roth conversions. And like you said, with whole life insurance or IUL life insurance, there's tons of benefit from a tax standpoint. There's no better way to basically have give money to somebody else than it being tax-free. And there's not a whole lot wrong with a tax-free death benefit from life insurance. And of course, there's tons of benefits that can be had while you're still living too. So that's why, we're a big proponent of that. So Steven, you have something to say?
Well, I was going to say, we have all of us individually, we've done all Roth and Roth. Everything we had in pre-tax accounts, we converted to Roths, as you know, because you did the conversion.
Correct.
And any contributions we've done this year or since the Trump cuts have all been to a Roth. And then we have a whole life plan that we've actually borrowed on probably 3 times to build buildings.
Right.
So it's been a really great benefit for us. We're at the break-even point with my wife's whole life plan, where we've actually, got more cash value than we've paid.
Right.
So now it's a really kind of a gravy train scenario. But and then I think another thing a lot of people don't know, because when they think about a Roth, they think about income limits. If you have a business, you can do a Roth 401k with a Roth option and get around any income limitations. And you can set aside 3 times what you could do in an individual Roth account. So it's a huge way to throw back some tax-free money. And then also conversions don't have income limits. I get that question all the time. So, you can be in the highest bracket and you can still convert to a Roth.
Exactly. So on that, the Roth 401k option for folks that don't have businesses where they can start that up. A lot of companies now are offering a Roth 401k component of their traditional of that plan. So if you have access to that, I would encourage you to tax diversify. Don't put everything in the traditional 401k. Allocate as much as you can to that 401k component. That way you're paying taxes on the seed and not the harvest. Yeah, like you said, you can pile a lot more money into that Roth 401k than you can a traditional.
I get a lot of folks, so individual folks without businesses, I get a lot of folks that don't even realize they have the Roth option at work. They have no idea. And if you are torn, if you're one of those that don't believe the Roth is a good idea, but your spouse has a 401k, one person can do regular, one person can do Roth. You can even do mix and match within your own plan. You could do a piece regular and a piece Roth. So all kind of options.
Correct.
That a lot of folks don't know they even have.
Yeah. And if you are, just kind of a point of clarification here, if you do have a Roth 401k at your office and you are getting a match, your contribution, if you designate that to go to the Roth component, the company match is still going to go to the traditional piece of that puzzle. So there's sort of built-in tax diversification there. But anyway, there is nothing wrong with a Roth IRA. And I think that's one of the greatest tools that we have in our tool belt. And I've told my clients over and over, I've done more Roth conversions this year than I did last year. I did more last year than I did the year before. And I think it's going to be a continuing, sort of a continuing trend that we see. So tax-free is the way to go. Steven, what about an audit? I know a lot of people sort of cringe when they hear the word audit, and there's, probably, pretty good reason for that. But when do most people get audited, and is there something that usually leads to some type of audit?
Yeah, that you'll hear about a lot of red flags, stuff like home office deductions and deductions that are like just really high for what you would think they would be. But like in my practices, I've been on, we started my own firm in 2013 and been with another firm, and I think quite a while before that. And we didn't have any, I think we only had one physical sit down audit. We've had quite a few, and I say quite a few, maybe 3 or 4 mail audits, so very few. And usually the mailed audits are not full audits. They're, hey, send me some more info on this particular thing. So in general, for our people that are making, a lot of our clients make, between 150 and $1 million a year, something like that. They're not super, super, super high incomers. And we just don't see very many audits there. The rates, I think that I looked at the rates earlier, I think it's 0.6% between like $500,000 and $1 million for individuals. It's super low. So the higher the income level is really the factor that'll get you flagged. So these 5 million and 10 million people, I think the rate goes up to more like 7 or 8%.
Right. Okay. Yeah. So for our listening audience, we probably don't have very many people who are making $10 million a year. If you are out there and you make $10 million a year,
you're getting audited.
You're getting audited. Give me a call here at the office, 478-254-3550. We'd love to work with you. Obviously, in all seriousness, we do have some very high net worth clients, but we'd be happy to talk to anybody. If you're listening to this and you want to schedule a time to chat with me, you can visit the website, www.talkwithlee.com. That'll take you to my calendar, and you can just book a 15-minute phone call, and we can talk about your situation to any level that you want. And I'll kind of go through some of the things that maybe I can add value to. If I can't add value, I'll certainly let you know that. But that's how the easiest way to get in touch with us is go to talkwithlee.com. All right, Steven, I know there's a lot of probably listeners to the show that, that may own their own business. And, as we discussed earlier, of course, your client base at this point is almost exclusively business owners. So what piece of advice would you give, a business owner out there who doesn't really get anything from their CPA other than just, filing annual tax returns or something like that? How should they approach or reach out to their CPA and say, hey, I want to start being a little bit more proactive in my tax planning?
Yeah. I would say just about every client I've ever picked up with a business, that is their complaint. That is why they are leaving their CPAs, because they say that they're not being proactive. I think it's important to understand a couple things is CPAs are busy. They're all very, very busy. They're like anybody else.
Hold on. I thought you only worked in April. And then after that, you just played golf
well,
for you don't play golf. You go to horse shows or something like that.
Yes.
Okay.
That is true. True. We don't do anything for 4 or 5 months a year, but they are, the CPA world is at some firms anyway, can be volume driven. And, but even besides that, 'cause that's not all firms. I think a lot of times the clients don't really say what they want. And it's because they don't know, I think, what they want. They just say the word proactive and they don't really know what that means, but it's July now. So if you haven't felt like your CPA is proactive, you call them today and you say, listen, I want in October, November, early December, even, I want to know an estimated where my tax is going to be, how much I'm going to owe, how much I'm going to get back, what my bracket's going to be, an idea to save tax if I need to save tax, or if I'm going to be in a very low bracket, how much do I need to convert from my retirement plan to a Roth this year without paying too awful much tax. And you tell them that. And a lot of times they'll make it work if they know. CPAs too, or they don't like doing, or I say they don't like, they get so much pushback when they bill for anything outside of the absolute norm that they're a little gun shy. And so you tell them what you want, and then they'll understand and it'll be clear. So you just need to be clear with what you need.
Right. And remember that CPAs don't work for free. I don't work for free. And really nobody does. You wouldn't go to wherever you work and put in your 8 hours and just do it for nothing. Everybody works for something. And I would say if you've got a really good CPA, what you pay them and what they bill you, you will save that, or it will add multiples of that value. It's the same thing we try to do here for our clients. I tell everybody, if you don't see a value for the fee that we charge, obviously you can feel free to move on to somebody else. Hopefully you could walk away, we could shake hands and part as friends, but we know that we are providing some multiple of value for the fees that we charge. And I know, Steven, you do that there in your office, right? Are you working for free these days?
No, we don't work for free. We do not work for free. But I'll tell you, we have, and you and I have a mutual client that I had 2 cases. I think it was last year before. But sometimes what you get from good tax planning is just clarity on where you're going to be, so you don't have the stress, and you usually can save some interest and penalties, and sometimes usually you can save a good bit of money. But we have a couple of cases that are just windfalls where it's something simple, like you buy a truck, it drops you down a bracket and a half, frees up all your child tax credits and frees up all this other stuff that you were getting taken away, and qualified business income deduction. And all of a sudden your $70,000 truck only costs you $50 by the time you take in the tax effect. So sometimes they're just huge windfalls, and it's nothing super special. It's just a matter of knowing your bracket.
Right. That's it. And so you want to make sure that you are aligned with a tax professional that can help you sort of seek those opportunities. Steven, this has been fun. We certainly want to try to do this again if you're open to it. Has this been too much pressure for you? You good with this?
Great.
All right,
it's been great.
There you go. And certainly maybe we can dig a little bit deeper into some of the specific items that we talked about, and maybe even some additional topics. I know we're both business owners and we like to talk business. So maybe we can do something that's sort of down that path. How can folks learn a little bit more about you if somebody wanted to get in touch with you? Where can they find you?
Well, we have a very outdated, terrible website at www.sbrewercpa.com. But you can just Google my name. It'll come up, Steven Brewer, CPA. I actually think there's another one in Indiana with my exact same name.
I've
And
seen,
it has gone from-
I've seen that guy. So if you search for Steven Brewer CPA firm, you want to make sure you find the one that is on Vineville Avenue. I'm looking at your website. I don't think your website's that bad. Your picture is a little bit distorted. You're a little bit wide on that picture, and you are not a wide guy.
Oh, well, thank you. Thank you. I appreciate it. I didn't know where you were going there.
There you go. No, I would say you are a very wise guy, not a wide guy. So, all right, Steven, I appreciate you coming on the show. Thanks a lot. This has been fun, and we will certainly do it again.
Yep, enjoyed it. Thanks,
All
Lee.
right, thanks. Take care.
Investment advisory services are offered by J.L. Perkins Wealth Management, a registered investment advisor and insurance agency. Information is for illustrative purposes only and does not constitute tax, legal, or investment advice. Always consult with a qualified tax, legal, or investment professional before taking any action.